Welcome to CoreLogic's housing market update for August 2025, brought to you by First National Real Estate. Our National Home Value Index notched up a sixth consecutive month of growth in July, following a slight dip in values at the end of last year. After a positive turn in February, which aligned with the first rate cut, the monthly pace of growth is held at 0.6% since May, as the opposing influences of low supply, falling interest rates, and rising confidence run up against affordability constraints and lingering uncertainty. Every capital city recorded a rise in dwelling values through the month, led by Darwin with a solid 2.2% rise, followed by Perth, which was up 0.9%. At the softer end of the growth tables are Hobart, Melbourne, and the ACT. The positive trend in housing values is supported by persistently low inventory levels, with national listing numbers tracking 20% below the previous 5-year average for this time of the year. At the same time, CoreLogic's estimate of annual sales is tracking about 1.9% above the previous 5-year average. The imbalance between available supply and demonstrated demand has supported auction clearance rates, which have been tracking slightly above the decade average since mid-May. Although the monthly growth trend looks to have found a sweet spot, the rolling quarterly change does show a clear upswing since February's rate cut. The 1.8% rise in the national index over the 3 months ending July was the strongest outcome since the 3 months ending June last year. The rate of growth in house values is once again outpacing gains across the unit sector. The past 3 months have seen the national house value rise by 1.9%, adding approximately $16,700 to the median value. In comparison, unit values are up a smaller 1.4%, or roughly $9,700 on the median value. With house values once again outpacing units, the difference between the national median house and unit value is at a record high. In July, nationally, there was a 32.3% difference between the median value of the two broad housing types, or approximately $223,000 in dollar terms. The combined regional markets are no longer outperforming, with the rolling quarterly gain once again favoring the combined capitals. The stronger capital city trend comes after 9 months where the quarterly trend rate of growth has been stronger across regional Australia. The strongest regional markets have seen a clear change since the pandemic, when commutable lifestyle markets were leading the gains. The current trend favours rural markets in Western Australia, Queensland, and South Australia, where housing generally is quite affordable and economic conditions are generally robust. Moving our attention to rental markets, with vacancy rates holding close to historic lows at just 1.7%, there's been some evidence of re-accelerating growth trends. On a seasonally adjusted basis, national rents are up 1.1% over the 3 months ending July, up from a recent low of 0.5% through the September quarter last year. The re-acceleration in rental growth is clearly bad news for renters, where the median income household would already need around a third of their pre-tax income to pay rent. Renting households have historically skewed towards younger, lower-income cohorts, so no doubt the sting of high rents is having an even more acute impact on household budgets. Dwelling values are up 0.7% across Adelaide in July, the strongest month-on-month gain since December last year. However, the market has clearly lost momentum, with the annual rate of growth easing back to 7%, less than half the annual growth rate a year ago at 14.6%, and well down from the cyclical peak back in March of 2022, when the annual growth rate was 24.5%. With a rental vacancy rate of just 1%, rental markets remain extremely tight. However, rental growth has eased, rising just 0.1% over the month of July to be 4.4% over the past 12 months, the slowest rate of annual rental growth since the 12 months ending January of 2021. The outlook for housing values remains positive, and we expect values to continue posting a broad-based but modest rise through the rest of the year, supported by an outlook for lower interest rates, improving sentiment, and short housing supply. The June quarter inflation outcome, with a quarterly trim mean at 0.6% and the annual core inflation reading reducing to 2.7%, which was the lowest reading since September 2021, sets the scene for an August rate cut and probably 2 to 3 more rate cuts over the coming 12 months. The housing component of CPI, which holds the most significant weighting in the CPI calculation, is one to watch, with a rise in annual inflation through the first half of the year from 1% at the end of 2024 to 2% in June, due to the expiry of federal and state energy rebates. The cost of new dwellings has also ticked a little higher, and the rental component of CPI could also see some renewed upwards pressure if the re-acceleration in private sector rental measures persists. Given that core inflation is now firmly around the midpoint of the RBA's target range, there's a clear expectation that interest rates will reduce further from here. Lower interest rates go well beyond providing a lift to home loan serviceability and borrowing capacity. We also expect to see a further rise in consumer sentiment as cost of living pressures are contained and the cash rate moves lower. Historically, consumer sentiment and housing activity have shown a very close relationship. Low housing supply is another factor supporting some upwards pressure on housing values, both from an immediate perspective via low advertised listing numbers, but also insufficient levels of newly built housing supply that's likely to be a feature of the market for some time yet. Building costs remain high and profit margins have been severely compressed, especially across the multi-unit sector, given the mostly below-average trend in dwelling approvals alongside extended approval to completion times and competition for labour from the public infrastructure sector. It's hard to see the cumulative shortfall in newly built homes being addressed within the next couple of years at least. Despite the tailwinds, the housing market's also facing a few headwinds. Housing affordability poses the most significant barrier to a material rise in housing prices. Data to March shows the national dwelling value to household income ratio at 7.9 is just shy of record highs. Although loan serviceability metrics are improving as interest rates reduce, higher housing prices are dampening the influence of lower rates. Elevated levels of household debt are another factor blocking a more material rise in home values. Recent statements from the Council of Financial Regulators and APRA make it clear that regulators are watchful for any sign of excessive debt accumulation as financial conditions ease. Other downside factors for the housing sector include the uncertainty related to geopolitical risk and tension around conflict zones, such as the Middle East and Ukraine, as well as the more normal levels of population growth that should help to dampen demand-side factors. On balance, the tailwinds of lower interest rates, higher confidence, and low housing supply are likely to outweigh the headwinds, providing the foundations for further modest growth in housing values in 2025. The coming months will be interesting to watch. As we approach spring, it's normal for listing numbers to ramp up, testing the depth of housing demand. You can keep track of all these trends and more at the insights pages of the Cotality Australia website.